second paper of the session, and now let me introduce the third paper of the session, Failed Venture Capital Fundraising Campaigns and Startup Growth. The presenter is Juanita. The floor is yours. You might share your slides and start whenever you're ready. You're still muted, Juanita.
Thanks. Can you see my slides? Yeah, perfect.
Perfect.
Great. Well, let me start by thanking the organizers for inviting our paper to the conference. It's a pleasure to be here. I will not repeat the title of this paper because it's incredibly long, and it's with a bunch of really good people who are not here, unfortunately. Okay, so let me start with a broad motivation of what this paper is about, and then I'll be much more specific about what we can and actually do in the setting that we focus on. So here's my broader picture. So we know that VC investors fund startups that become some of the world's most innovative firms. If you think about the US, we know that VC-backed companies account for roughly 40% of market cap and roughly 60% of the value of patented innovations. Now, this link between VCs and innovation is not only in the US. By now, we have good evidence that it is global. So VCs are present in startup clusters around the world, in London, Shanghai, Silicon Valley, Tel Aviv, you name it. And we also know from research that the link is also not just a curiosity. So for example, we have very good evidence by now that VCs provide so-called smart money to the startups in which they invest, meaning they provide capital, but also they add value through several mechanisms, like the operational expertise and the professional networks that they make available to the companies in their portfolio. What we know less about is the effects that VCs can have on companies they do not invest in. And that's exactly what we want to focus on in this paper. We want to offer a new line of research examining the impacts that VCs have on companies that they pass on and do not invest in. Now, what is the main motivation behind this question? So it is the empirical observation that VCs spend significant time and resources on startups outside of their portfolio. And they do this primarily through due diligence, which is the process that they use to scrutinize firms for potential investment. To give you a sense of how important that can be in practice, you know that for every one company in which they invest, this is considered roughly 100. And of those, they closely interact with roughly 30 through the different stages of due diligence. Now, we also know that due diligence is considered crucial by investors, for VC returns. We know that it also appears to add value to portfolio companies. But our novel premise in this paper is that due diligence can also add value to the companies that VCs scrutinize, but ultimately reject for investment. Now, this premise is consistent with anecdotal evidence. So we often hear entrepreneurs saying that, going through the process of due diligence can be a process through which they learn a lot. But however, it's not an obvious kind of premise to the extent that we also hear entrepreneurs say that it's incredibly time consuming and it can be distracting because they focus on raising money where they should be focusing on growth. So not an obvious answer. So ultimately it's an empirical question. But answering that question empirically is hard. There's at least 3 challenges. So the first one is that observing firms that go through due diligence but do not obtain investment is quite rare. So by definition, all the publicly available sources are conditional investment. So it has companies that eventually raised financing. And we're interested in the bigger pool of companies that sought to raise financing. Second challenge is that tracking startup growth is hard. So many of the companies that go through due diligence processes do not end up raising financing at some point in time. They may also not make available their financial accounts to researchers. So it's just difficult to track them over time. And finally, the most pressing challenge in some sense is that selection for due diligence is endogenous. And that's because VCs decide to conduct due diligence based on a number of observable and unobservable factors. And that means that comparing the growth of companies that go through VC due diligence with those that do not can lead to biased estimates. For example, if VCs select for due diligence those companies that appear more promising to them. So what do we do in this paper? So in this paper, we're going to focus on one side for which, while we cannot completely overcome these challenges, we can mitigate them to such an extent that we think we can contribute to looking at the value, a potential value added due diligence. And so what's going to be that setting? We're going to partner with one seed fund seed VC fund in the UK, and I'm going to refer to it as fund throughout. And they give us information about nearly 2,000 startups that applied for investment to the fund. And in this way, we address the first challenge that I mentioned before, which is just observing companies that go through due diligence. Now, to mitigate the second challenge, which is measuring startup performance, what we do is this for these firms. We collect administrative data from startup filings with the UK Business Register, because it turns out that the vast majority of the applicants are in the UK. Now, for identification, so to address the third challenge that I mentioned, so selection issues, we exploit the fund's process to select applicants for due diligence. That involves random allocation of applicants to reviewers within the fund that happen to vary in how generously they tend to score applicants on average. Some people are more generous than others, and that provides somewhat exogenous variation in the types of companies that end up being selected for due diligence. And that's what we're going to explore. Now, what's our main finding? We find that assignment to due diligence leads to startup growth, and this is true even for companies that do not end up being selected for investment by the fund, so-called non-portfolio companies. And so the main implication of our results is that they suggest the VC's role in innovation can be broader than previously acknowledged, to the extent that it does not involve only the value add that they can provide to their portfolio companies, but also the value that they can add to a range of kind of like a wider range of companies they interact with through due diligence. Okay, so that's in a nutshell the paper. Let me now tell you more details about the setting. Let me start with the fund. So the fund, the seed fund, is recently established in 2016. It focuses on software, and by November 2019, it had received roughly 2,000 applications, which is the 1,953 number of observations you see in that table. Now, what did we get from the fund? Information about these companies from the application. And so we have, for example, the age of the business since incorporation. To give you a sense of how old these companies are, they're basically 2.61 years old since incorporation. 13% have at least one female founder, which represents, it's very representative of the types of companies that apply for VC. In terms of location, the majority are within the UK, as you can see in the plot, and conditional on being in the UK, they're like half and half located within London and outside of London. Again, very representative of the distribution of entrepreneurship within the UK. In terms of stage, these are very early stage firms. They're seeking pre-seed, seed, or seed extension investments. So that's the data that we got from the fund, from the applicants. Then what we need to do is track their performance over time. And as I explained, the way we do that here is that we collect information about their performance from, it is administrative data, from the filings that companies have to do with the UK government, which also apply even for very young firms like the ones in our sample. So we have information about the assets, their equity issuance. We also know how many people they have, like in executive positions. We also know, or we can track in a very good way, survival, which is another challenge in this kind of work. Now, we also collect information from online, as it's kind of like standard in this type of papers. We have information from countries and from LinkedIn in terms of the fundraising that these companies eventually do, and also in terms of the number of employees that they report having in LinkedIn. Now, when I measure performance, what do I really mean with that? This is performance after application to the fund. Now, companies apply at different points in time, and they file the information with the UK government at the end of the fiscal year. So what that means is that I have a varying window across companies on how long I observe post-application. On average, how long is that window? Roughly 2 years, so 1.9 years post-application. That's what I mean with performance here. Okay, so that's the application data. How do we track performance? Finally, how do we deal with selection? So let me start by showing you the selection funnel. So companies that apply to this fund, the first step is that they're selected, or they're allocated into 3 buckets. The first bucket is they're selected for due diligence. That's what I mean with due diligence assignment. And roughly 30% of the applicants are assigned to that bucket. But there's 2 other potential buckets. The second bucket, so firms that are not assigned to due diligence assignment, they could be, in any case, assigned to an informal chat, meaning the company invites the founders, to have a coffee, talk about the firm, but it's clear from the get-go that they're not interested in being investors. Finally, the last bucket are the firms that are assigned to no meeting, and this is because the company deems them as non-venture backed. Now, if a company isn't being assigned to due diligence, what happens next? So there's roughly 3 stages that a company goes through, and this is very representative of other VCs. So the first stage, what the company does is it meets a investment lead, so someone within the company that has been assigned to, within the firm, that has been assigned to the company. And what this investment lead does is, they have formal conversations with the company. And for this particular fund, something that's very important is that the companies are expected to complete very detailed spreadsheets with cash flow projections, unit economics, and cap tables. If the company goes well through that first stage, then it passes to a second stage where it meets other fund members other than the investment lead. And finally, the third stage, the company qualifies for what's known as the opportunity assessment. This is the last stage of due diligence, and this is where the company is invited to do a formal pitch. External reviews are requested, for example, from industry experts. References are asked, and the company is also asked to share the so-called data room with the VCs. Now, how exactly does the selection work? How are companies assigned to these 3 different buckets? So that selection process has 2 steps. The first step is that the applicant is assigned randomly to 3 reviewers within the fund. And what the reviewers do is that they assess independently the company. They record comments. So they basically write down any comments they may have for the firm, and they provide a score. Now, the score is a discrete number from 1 to 4, where 4 is best, 1 is worst. Now, we have 12 reviewers in our data and roughly 2,000 companies. So the way to think about our data is one in which we have few reviewers, but each reviewer has looked at a very big number of potential participants or applicants. At the mean, it's like roughly 440. Now, consistent with random allocation, we do a lot of tests, and we show that the companies are very similar across reviewers. And what's important about reviewers, which is what I mentioned from the very beginning, is that they vary in how generous they are in providing scores. We can show that some tend to be much more generous than others in providing, for example, a 4, rather than assigning a lower score, like a 1 or a 2. Now, that's the first step of selection. What happens in the second step? Because there's 2. The second step, what basically happens is that an aggregation rule is applied based on all the scores. And the specific rule varies across locations and across time. So here's the rules. The easiest one to explain is the one that applies for London. The rule that applies for London after May 2018 is the so-called champion rule. So basically, a company is assigned to due diligence as long as, or at least one of the reviewers scores the company with a 4, right? For any other score combination, the company is not assigned to due diligence. Now, once the companies have been assigned to the different buckets, what happens next? The information is communicated to applicants. They receive an email, which tells them whether they've been selected for due diligence, informal chat, or no meeting. The email includes the comments, does not include the score. And also, it doesn't include the names of the reviewers of the company. Okay, so that's the setting. So what do we do with this? Our main question is understanding what's the impact of due diligence on performance. Now, of course, the challenge that I mentioned before is that running regressions like equation number 1, it's complicated, right? Because the fund selection is endogenous. So ideally, what we would like to find is a variable that affects due diligence, but doesn't affect performance through any other mechanism. And what we're going to do here is we're going to exploit very heavily the idea that companies are randomly allocated to reviewers that vary in how generous they are in the scores that they provide to the applicants that they review. So how do we exploit that in practice? For every applicant, we estimate what we call the due diligence assignment probability, for short DAP. And what this does is the following. It basically reflects the exact probability that a company is selected for due diligence as a function of the 2 aspects of the selection process that I explained before. The specific selection rule that applies the moment that the company is applying for due diligence or for investment to the fund, and also, and importantly, the average generosity of the reviewers that are randomly allocated to the fund. Now, using that as an instrument, we then estimate our object of interest, which is the effect of due diligence on performance. For this approach to work, we need a couple of things to be satisfied. So the first is that indeed, this DAP that we've constructed is predictive of due diligence, and that's something that we can show. In particular, we find that firms that have a higher DAP, they are indeed more likely to be accepted for due diligence, meaning if companies are assigned to reviewers that tend to provide higher scores, they are indeed more likely to be assigned to due diligence by the fund. Now, the second thing that we need for this to work well is that DAP affects performance only through due diligence and not through any other mechanism that you can think of. Here, the random allocation of reviewers across companies helps us a lot. It's relatively easy for us to show that companies are very similar across different levels of DAP. Okay, so with that in mind, what do we do then? We return to our object of interest. So let me show you results. So we're really interested in what's the effect of due diligence on performance. And I'm going to focus here on the results on funding. So I wanted you to stare at column 2. What this tells you is that companies that are allocated to due diligence end up raising much more money than companies that do not from VCs other than the fund that is conducting the due diligence. Now, how much money are we talking about here? The magnitude is roughly £142,000. So if you are allocated to due diligence, even if you're not selected by that fund to be part of its investment portfolio, you will raise much more money going forward. On average, £142,000. Now, this is true not only in terms of funding. We see these results also in terms of other measures of growth, meaning the number of employees, their assets, their leverage. The only exception is we do not find robust results on survival. Okay, so once we have that, we have a couple of remaining questions. The first question is, if we take these results at face value, and we think that due diligence indeed increases startup growth, what we want to understand better is the mechanisms to which this occurs, right? So how is it that venture capital due diligence adds value to startups? And we basically think about two broad mechanisms. The first mechanism is what we call type improvement. It's the idea that by going through due diligence, entrepreneurs can acquire resources that lead to startup growth. And these resources have a variety of, they vary quite a bit. This could happen either through learning by doing. So the entrepreneur learns something by just, filling down the spreadsheet that I mentioned at the beginning, or they actually get coached by the VCs and learn information from them, or they're introduced to, different contexts that are important for performance. Now, the second broad mechanism is what we call type discovery. Is the idea that the mere selection to due diligence can convey a positive signal to the market and the entrepreneur, which leads to startup growth. So you think of potential certification and validation effects. So the notion that I am selected for due diligence somehow signals to the market that I'm higher quality. And likewise, the fact that I'm selected to due diligence tells me that my firm is good, that I'm a good entrepreneur. And these can lead to startup growth as well. So what we do in the last part of the paper is try to assess whether the evidence points to one or other mechanism. And at this point, we don't have any exogenous variation, so all the evidence is very tentative. But we construct a case for type improvement. And it's very consistent with the fund's perceptions from very, very long interviews that we performed with them. Instead, we think that type discovery effects are less likely in this setting, and that's for a number of reasons. So first, the fund was newly created at the time of study, and is the first investment fund raised by GPs. Moreover, due diligence assignment is private. So what that means is that this potential role for type discovery is less likely to be occurring to the extent that the VC fund doesn't have any reputation that, for example, the market could interpret as conveying a signal of quality of firms. So then there's two final questions. The first one is, well, again, if you take results at face value, what incentivizes the fund to add value to firms that do not become part of its portfolio? So this looks like ex post inefficient, because what it means is that the fund, can't really appropriate returns for most of the companies that benefit from this value add through due diligence. So why bother? What we think here is that, however, adding this value through due diligence is ex ante efficient. And that's because the probability of investment for the companies that are being considered during due diligence is non-zero. And by adding value through due diligence, then what the VC can do is basically increase the chances of a deal, and it could also increase future deal flow as they establish a reputation of being a value-add investor. The final question, imagine that we take the results at face value. This looks reasonable because it's exposed efficient. How much can we extrapolate from this to other settings different from my fund or the fund that I partner with? I mean, we are very honest here in saying the fund is peculiar in a number of ways. The fact that it has this random assignment of applicants is not necessarily super common, especially among traditional funds. But the fund is representative of a type of fund that has become increasingly important or more prevalent during the last couple of years, which are seed funds, that use these types of methods to both assess the quality of potential applicants. For example, many of them take applications online. So we think that our results are more likely to apply to other funds that are recently established, and as a consequence, can have more incentives to add value through due diligence. And that's because that can help them improve deal flow going forward. So let me conclude, and I'm concluding early. So in this paper, we provide the first rigorous evidence that venture capital due diligence can be a key driver of startup performance. And this is even for startups involved in failed fundraising campaigns. And that is the key novelty in our study. What we think these results imply is that VC's economic role can be broader than existing research acknowledges. So it's not only about them, potentially addressing some funding gaps in the economy because they provide financing to companies that perhaps otherwise may not be able to raise money, from banks or other types of investors. It's not only necessarily about adding value to the portfolio companies through professional expertise, through networks, and many other mechanisms that have been studied in the literature, but is also potentially through their due diligence. VCs can impact performance for a much larger number of companies than the small set in which they invest. And our results suggest that this is especially through type improvement and not necessarily only through type discovery, so the notion of certification and validation. Now, we acknowledge that our work is not necessarily representative of every VC fund out there. We think it's most representative of young seed funds that are increasingly prevalent in entrepreneurial markets. Thank you.
Thank you very much, Juanita. So let's immediately jump into the first discussion by Anat.
So first, thank you so much. Thank you for inviting me, and thank you, Juanita, for a great presentation. I learned a lot. I think this is a great project, and I do have some comments and some questions, and I'm quickly going to present them now. First, I'm just going to start a little bit with your contribution to the literature and also some suggestions from me on how I think you can honestly even further contribute to the literature, some things that I think would be very interesting for scholars like me. So first, you're showing that VC due diligence can add value to entrepreneurs. I completely agree with that, especially due to network effects. And it's true even for those entrepreneurs that are not selected for investment. And what I liked is the fact that you're looking at follow-on investments. So what happens before and after the due diligence process, and the fact that there's this, and I'll talk about this in a second, about this signaling effect to the market. And I saw that you were debating in the piece on that, and I'm going to touch on that in a second. The second issue is on the role of venture capital in innovation. I think it's very important, and especially today, I'm not sure if it's happening in the UK, but here in the US, and I was hoping that you can expand on that a little bit if that's also the case, is we've seen this divergence because of new money coming in and flowing, because of tourist investors, alternative venture capital investors. What we've seen is traditional venture capital funds actually split up into ones that are going back and investing in pre-seed or seed investments, and others that are focusing on late stage, and really partners that just diverge on what should be done and the due diligence that should be done. The other thing that's important is the VC's ability to make decisions, drive performance, pick winners. And I was hoping that you could emphasize a little bit more on that. How are they picking winners? And whether and this is where I think you could contribute further to this literature, there's a lot of criticism here in the United States on diversity, on democratizing the access, on the fact that we don't have enough groups that participate in this. And that's where I thought this was interesting, opening it up to more people. Is it helpful? I was wondering whether you were able to show, is it helpful? Do we see more groups from, let's say, outside of London, more minority, diversity groups are able to get investment as a result of, opening that access? The other one is with regards to efforts to, build builders through feedback, networking. I'm going to touch on that too. And finally, the different implication, rather than explaining the performance of VC funds and the selection process, but to focus on the selection process. And that's where I really want you to maybe dig a little deeper on the due diligence. What kind of due diligence process are we talking about? And as you know, here in the US, we have this concept of the value of debt, right? So it's, we have this time, less than 1% of new firms receive VC funding in general. And as you know, the startup innovation is fraught with challenges. They face lengthy, costly, and risky process for the innovation. And even the ones that the VC does invest in, by the way, so you're talking about the ones that they chose not to invest in, but even the ones that they do invest in have to go through this valley of debt, okay? And there's a gap, and what it refers to is this gap between, information between the entrepreneur and the VC, and I wonder if that's part of, in this due diligence, are they mitigating? Of course, they are mitigating some of that, but again, if you could focus a little more on how they pick their winners, that would be great, because you can add to that literature as well. And with regards to the services, right? So VC adds services and contributing to that literature as well. We know about mentoring, networking, evaluation of business plans, and commercial feasibility. And so, again, you're kind of touching on that, but you're not clear on what is the added value here that your paper thinks that is really the one that's focusing on. To me, honestly, I think it's the signaling to the market. If I was an entrepreneur and I was going through this due diligence process, I would be telling everybody that that's happening, at least to get other VCs to invest in me. Okay. One more thing, the impact that VCs have on companies that they don't invest in. And you're talking about the meetings, and I was wondering if you can also perhaps, through the data that you have, expand on how many meetings, if you have information or what transpires in those meetings, and then you can also add to the literature by Gompers, Gorno, and Strabulaev. The other thing is with regards to the assignment to the due diligence by the fund. I was wondering if you have information on the reviewers. Are the reviewers diversified? I think that could also contribute to that literature on diversity. And this is just, some suggestions. So this is like a traditional acquisition versus VC. And these are some stages, right, on the types of due diligence. And so that's what I'm referring to when I say it would be nice if you can expand a little bit more on the due diligence. So what kind of due diligence are they doing in the seed stage? Are they just looking at market opportunity? Are they, of course, I think founders, it makes I think a big difference, and that's when they pick winners. Because let me go back to that. One more thing that you said in your presentation, but I think you should specify in the paper, is that there's really two types of VCs, even seed VCs. One are specialized, the other are generalists. And I think here you are referring to the specialized because they usually invest in certain markets, they have expertise in a certain group, and they focus on certain locations, even if they're expanding the search, right? And they're allowing more people to enter into, is it working, not working? That's what I mean. It would be nice if you could build on that. But here really on the focus areas, it would be nice to see what are they focusing on. Is it the founder's competency? Is it the market opportunity, the existing assets, the risks to the existing assets? Now, as I said, with regards to the investment follow-up, I think this is a great contribution. I would emphasize that. And I do think that there's definitely signaling here. I think there's signaling to the market that, okay, they went through this startup went through our process, and even though we're only talking to them, that's still a big deal, because there's such a small percentage that goes through this process, because they had to go through a lengthy vetting process to even get there. With regards to, again, what your paper can build on is with regards to democratizing access, looking at that, or perhaps that could be a different paper. Are they able to democratize access by just accepting application through the fund? What happens with focusing on location, especially in your case, for example, firms that are based in London? Is it only where they're headquartered? One more thing that's interesting to me is incorporation. I don't know enough about UK, but it would be interesting to me, where are these firms incorporated? Does that matter? If you find consistency, are they all incorporated in the same place or not? Another thing is, you touched on a little bit about the founders, the gender, and so that would be interesting to me to see whether that helped. Do we see more investments in diversity? Candidates could be gender, minority, also education. Does it matter on the university that they're coming from, and of course income inequality. Of course, we have networks and connections. So does that help with that? So let me just make another two quick suggestions. One is, again, expand on your selection process. Why did the VCs provide high or low scores? How did that affect the due diligence selection? And again, perhaps you can get some information on the identity of the reviewer. Are they diverse or not? Does that contribute anything to this? The second one is, I think there's a problem here, and I think you touched on that very briefly. And the problem is what we've seen, and we've seen this actually a lot the past 2 years here in the United States, and this spray and pray strategy, in which we have the very early stage investors, and what they do is they make a large number of small investments, and they are trying to invest in as many companies as possible. And so that would be interesting to see, how does that expand or lessen the learning opportunities post-investment? Okay, so thank you. Those are kind of my comments and suggestions.
Thank you very much, Anat. Let's immediately go to the second discussion by Calum.
Yes, good afternoon. Hopefully you can hear me okay.
Yeah, we can hear you well.
Yeah, so I'm very grateful for the opportunity to review and comment on what I think is a really excellent paper. I should say at the outset that I'm not an academic, so I'd ask you to forgive me for what I'm sure is a much more kind of intellectually lightweight and uninspiring review of the paper than we've just heard. But there is actually much in the paper that I agree with. I think in setting the context for the research, the authors rightly point to the evidence that venture capital plays a really significant role in successful technology clusters across the world through the provision both of much needed capital, but also value add for startups. In other words, smart money. That is a very well made point. And obviously venture capital covers investment at various stages. What I do for a living is a much later stage than what we're talking about here, which is essentially the very early end, the kind of pre-seed formative stage of the market. Actually, activity that is crucially important, because without those new companies being formed and financed, there'll be no companies of scale that can develop in a way that enables them to disrupt markets and drive economic growth and prosperity and so on. I sort of agree with all of what was said in terms of the significance of venture capital, which of course is not perfect in terms of consistency and coverage, and that's because in practice it combines significant subjectivity as well as objectivity, when selection of companies for due diligence, and also due diligence itself, where that's concerned. But I do think it's relatively straightforward, both evidentially and anecdotally, that there is a strong correlation between venture capital investment and company growth and success. And the paper makes this clear, I think, along with entrepreneurial leadership and talent and the existence of a supportive business environment. I think they're the key things, along with venture capital, that contribute to vibrant technology sectors across the world. And it's one of the reasons, of course, why governments everywhere are doing whatever they can to promote venture capital. But the thing that really did interest me about this research was the focus on companies that are unsuccessful in raising investment from VCs, and the fact that it finds that these companies still benefit, specifically that they benefit from the due diligence that has been undertaken by the VCs before reaching the decision not to invest. And in particular, type improvement via coaching and learning by doing and networking support and so on. I have to say, at one level, that is not hugely surprising to me. I think feedback from any process that ends in failure can be informative and valuable. Athletes, for example, often talk about learning more from defeat than victory. And as a former judoka, I've got numerous opportunities, or had numerous opportunities, to learn from the former. And as a venture capital investor, I've spent more time actually reflecting on learning points from investments that have ultimately been unsuccessful than those that have gone on and done well, on the basis that they're often much more informative than those that have succeeded. But I think this is really interesting research, because the ratio of success to failure in terms of companies actually raising venture capital, it is so low in practice. I don't know if every fund invests in as few as less than one of every 100 applicants for funding. Maybe not, but what we do know is that the number of successful applicants is certainly very low. And that's not necessarily a sign of a purely functioning market. I think the idea that the demand for capital and the supply can never be in some kind of perfect equilibrium, it doesn't really make a huge amount of sense, because not all companies have the attributes that merits funding. And not all companies, of course, who raise capital, will be successful. But if it is true that the 30% or so of the unsuccessful applicants that they go on, to benefit as a result of having had due diligence done, then that is obviously quite significant, very significant, I think. And so the question the paper, I think, partly addresses is, what is it that is incentivizing investors to add value to companies that they don't end up investing in? Well, I think there are a number of reasons for that. One is that, of course, one day they might end up investing in them. But a second key point, and I think this is made in the paper, is that in a competitive process, in a highly competitive market, which is what venture capital is, i.e. the best ventures, the best companies tend to attract a lot of interest with a lot of competition to win the deal. The VC has a far better chance of having their term sheet accepted if they can demonstrate knowledge and value add through the due diligence process. And of course, there's another fundamental incentive, which is that the ratio of satisfied customer, if you like, for a VC, in other words, successful recipients of capital who go away happy versus unsatisfied, those that are unsuccessful is heavily skewed. So ideally, I think you want those who are unsuccessful to leave with at least a positive view of the firm and the experience, not least because of the network effects of spending time with companies, regardless of whether you're going to invest in them, makes a huge amount of sense. I think investors do thrive and survive ultimately not just on their ability to invest money, but on whether they add value. That's certainly true of the best investors. And I think the paper rightly talks about the broader economic impact and the network effect. And I think that's part of the key proposition for VCs when they're making a case for taking the capital from them. My experience certainly is that going through due diligence allows companies to get very useful feedback in terms of helping them to refine their pitch, strengthen their market proposition, refine their team requirements, maybe identify weaknesses in the underlying proposition, and armed with that information, it's not surprising that some of them will then go on and resolve some of these issues and make improvements and be successful in the future. I think it's also understandable that VC firms use type improvement to assist the due diligence process and the selection. Happy to do management coaching, happy to use their network. As I said earlier, they're in sales mode. They're trying to prove that they can add value to a management team, and they're trying to fundamentally gain a better chance of winning the deal in what will be almost almost certainly a competitive situation. So it's hardly selfless in that sense. I am really interested in the numbers, though. I mean, firms that are selected for diligence in the paper, 30%, approximately 30 out of every 100. And the argument is that these companies are in the main likely to be more successful in the future, even if they're not the kind of 1 in 100 that's ultimately invested in. I think that's quite interesting. I suppose one of the reasons for that is that these companies, that 30% of companies, the subset, I would have thought they're likely in broad terms to be stronger companies anyway, because there's at least been some pre-selection. In other words, the wheat has already been separated from the chaff rather in that sense. But I was I think as a minimum they've got something going for them to be selected for due diligence in the first place. I'd be interested in a sort of further comments on that. I also I wondered about just the numbers here. The data I think is from around 2,000 companies over 2.5 years, March 2017 through to I think November 2019, and of those 600 companies went through to due diligence. So I wonder just how extensive and useful that diligence could have been and what it actually comprised of. Now, maybe this particular fund is especially highly resourced, particularly so for a seed fund, but it's quite difficult for me to see how they might have done in-depth analysis of, 240 companies a year, 20 a month, 5 companies a week, particularly if they've taken some holidays. So perhaps it's been more light touch, and therefore I wonder just how instructive it really will have been for founders, to what extent these companies have gone on and done well anyway. I also wonder,
Calum, just sorry for interrupting, but to keep time for Q&A would be great if you could conclude within the next minute.
Forgive me for overrunning. I suppose, finally, to what extent is the VC due diligence always constructive? Lots of companies will benefit from the process, but for many others, this might not be due to VC due diligence, and there is also unconstructive due diligence as well, not least because early stage companies are pretty delicate things, and VCs don't get it right all the time. So yeah, forgive me for taking up too much time, but that was my kind of high level feedback on what I think is a really excellent paper.
Thank you, Calum. Juanita, do you want to respond very briefly? In the meantime, everybody who has questions, please send a queue in the chat.
Yes, let me start just like David by thanking both Anat and Calum for the comments. Those were really great. Anat, if you can share your slides exposed, that would be fantastic.
Sure. I'm happy to send it to you, or do you want me to share it now on the screen?
No, afterwards. Yeah. In terms of comments, I just have a couple of things to say, and they're all basically in agreement. So the first is that, yes, in the UK, we have the same kind of evolution of the venture capital industry in some sense, meaning now we have like a lot of seed funds that are focusing on the early stage, and then we have like the other VCs, more traditional ones that are focusing more on later stage. And I would say that there is indeed a discussion about the spray and pray strategies and how these can have, I would say, a potentially negative effect on the economy, to the extent that as VCs take lower stakes, then they have lower incentives to add all this value, provide governance, increase governance in the companies. And I think most of the debate has been around that, like this negative side of these other types of a strategy like spray and pray. I think that if you take our results at face value, I think what we're adding to that debate is there's another complementary view to that, which is kind of like a brighter story, which is by focusing on earlier stage firms and giving them a chance, there's a probability that we are helping companies that otherwise wouldn't have been seen. And the way that these VCs help them is not only potentially by actually investing in them, but by considering just looking at them to begin with, right? This initial assessment. And I think that's one way to think about our results, is not ruling out the fact that spray and pray can have negative effects. It's about providing a complementary view of a potential brighter effect of this change of strategy. Diversity is a key question for us. This was one of the main things that we were interested in this project. I can tell you the following. This is, of all the projects I've worked on, this is the project in which we see less heterogeneity. Meaning, if you cut the data in different ways, let me compare male founders with teams that have female founders. Let me compare companies that are in London with those that are outside of London. People that have different types of education, right? Those that went to reputed universities, like part of the Russell Group, and those that did not. We typically find that the benefit just as equally. So there is really no heterogeneity that we can see in our data. At the moment, we're trying to figure out whether there's a different way to benchmark results. So I can tell you that both, for example, male-funded companies and female-funded companies benefit equally from this potential effect of due diligence, but we want to see whether the types of companies that end up in the funnel look fundamentally different from those that are funded by VCs. And that's something we're working on right now, trying to come up with the best benchmark to say something meaningful from our data. Now, in terms of how do they select, how does due diligence add value, and going back again also to Calum's, some of his comments, it is our particular fund it's clearly not representative of the more traditional VCs that people may have in mind, right? So this is clearly not Sequoia for many reasons, right? So it's not giving the same type of deal flow, and the time they spend with each company is quite different. They spend a lot of time in due diligence, and the way that due diligence looks here is one important aspect is the spreadsheet that I mentioned, and I didn't have time to show. So all the companies are expected to fill out a spreadsheet, and they often do this with the help of one of the investment lead within the fund that has information about cash flows. So they want founders to think very deeply about where these cash flows are coming from, what are the levels. They force them to have a long-term view. They have this thing they call the future gaze. It's a 10-year window to describe exactly what's going to happen going forward. And finally, to think very seriously about their cap table. And so now, clearly, most of the things they will put in the spreadsheet, as everyone knows, will not materialize. But I think it's the effort of going through that process for companies that are super early stage and may not have done this properly before that could be explaining the value add that we see here. Now, not every company is getting all the way there. And that is one disadvantage of our data. And this goes back to Anat's comments and Calum's comments. Unfortunately, I do not know of those that were selected to due diligence, how far they went through in due diligence. I only know which ended up in the very last stage, when you actually have like they do a formal pitch with the fund, et cetera. But I don't know who completed successfully the spreadsheet, right? Who got a referral to another VC or a potential customer. I don't have that. They didn't keep track of that, which is a shame. So I think I'm not going to be able to say much more there, rather than describing better what the fund actually does. So yeah, that's it. And as I said, heterogeneity, going back to Calum's last point, who benefits more, who benefits less? Every cut of the data tells me that everyone benefits just as much. Yeah.
Okay, thank you. So let me take the next two questions together. The first one was by Tobias.
Yeah, thanks, Juanita. Really fascinating paper. So my question is, you touched upon it a little bit in your response to Anat's comment. So the firms that don't receive funding in your sample are really those that receive a negative decision from the fund, or is that they simply drop out at some point? The reason why I'm asking, if it's the latter, it may well be that they are simply essentially finding better funding somewhere else. And then, of course, the effect that you observe is entirely driven by other variables, obviously. So maybe you can account for that a little bit by looking at who picks them up, right? So maybe that's possible because it's a relatively small sample. Alternatively, the observation period that you're looking at is relatively small. It's relatively tiny. So what gives you confidence that your fund, the one that you're looking at, is not systematically getting it wrong? I mean, they're just rejecting the wrong ones, right? Which, there's learning over time, but this is a relatively short time window. And then third point, sorry for that one. So can you describe a little bit the identification strategy that gives you confidence that it's really the due diligence value added that you're observing and not just picking? Because if they are picking correctly, then those firms that they fund are those that are the best ones. Then the second bucket, those that go into due diligence, are okay. So they should also perform well, right? And that's exactly what you observe in your data. And therefore, what's the identification strategy that really gives you confidence that this is through the due diligence and the engagement of the VC firms?
Simon, your question?
Yeah, that's a great comment, and to some extent echoes some thoughts I had. But as a lawyer, I just don't understand a lot of your methodology anyway, so I'm not going to attempt to dissect it. I love quantitative analysis, even though I can't do it. But I also love qualitative analysis, and my comment was just a suggestion really as to whether or not it's possible to follow up with some interviews to try and understand from the entrepreneurs, what it was about the due diligence process that they found helpful. I wonder whether some qualitative research as a sort of an adjunct to this might be helpful to try and isolate the effects of due diligence, if there are effects, and how it was perceived by those people that went through it and what they feel like they learned and got from it.
Juanita, do you want to respond?
Yeah, absolutely. Let me start with the last question. Yes, I think this is one of those projects in which really getting at the mechanism quantitatively is very hard because we don't have variation to do that very convincingly. So interviews would be fantastic. And that's definitely in our to-do list to try and understand deeply what's really going on here. In terms of the comments by Tobias, so yes, we can definitely take a look at the identities of the investors that end up funding the companies that do not get funded by our fund. And we're in the process of doing that. It's not hard, as you said, because the data is relatively small. So that's something we can definitely do and say a little bit more of what happens to that fundraise, who's providing this fund. Definitely we can do it. In terms of the time period, you're absolutely right. There's, I think, two things I want to say about that. So the first one is, one thing that is striking in our data, from my perspective, is that we find that reviewers actually are good at predicting growth within the short window that we focus on. The reason why I find that interesting is because if you look at other papers using VC data, right, which, and again, these are firms that are focusing on more later stage firms, typically what we observe is that what VC partners thought at the beginning and how they predicted companies would perform is not really predictive of reality, right? There's this disconnect between what you think was going to happen and what actually happens. But it seems that a young fund, they do have some predicting ability. I think that the reason behind that, partly, is that what these guys are doing relative to a traditional VC fund is very different. A traditional fund is trying to discern within the top which are the best companies. My fund, because it focuses on early stage, often pre-seed or seed investment, what they're doing is not within the top discern the best, but cleave the bottom of the distribution. And that's what my predictability of reviewers is really reflecting. The ability that they have between distinguishing what's really not going to go anywhere versus that has some potential. So I think that explains why also I see this predictability in the data. But you're absolutely right. This is short term. We would want to take a look again in the longer term, and that's definitely something we can do. We have COVID in the in-between, so that's something we're going to have to address somehow going forward, but that's something we can do. And finally, in terms of identification, our paper is entirely kind of like inspired by the setting, which we thought provided like a nice setting to really go after understanding the causal effect. Intuitively, what our identification strategy does is exploit the fact that two firms that are just the same in terms of growth potential may have different probabilities of being selected for due diligence because they have been randomly assigned to reviewers that are more or less generous. And that is the way to understand our identification strategy. So I may be a really good company, but if my reviewers tend to be or to assign very low scores, the fund may reject me. Likewise, if I'm a not so great firm, but I happen to be assigned to a reviewer that tends to provide high scores, I'm likely to go in. And that's where our experiment or the variation in our data really comes from. So yeah, that's in short the intuition.
Thank you very much. So let me thank all the contributors to the session. I mean, these were 3 great papers and 6 fantastic discussions. We'll resume in 12 minutes.